Quickly, I think we're getting the cycle very similar to what we had back in 2020, where the stock market, the Fed began cutting, and then they kind of paused there, and the stock market went and made a new high. But then we got that crash move, 35%. And I think you're going to see the S&P probably drop 50 to 65%. Now they're resuming the decline again. The decline in the federal funds rate has been associated with the recessions and the bear markets. Here, again, Fed started cutting. Stock market went to a new high. Fed resumed and then again panicked surrounding the pandemic. And I think you're going to see something similar to that. You're going to see the Fed panic here in the coming months ahead, probably December or January. Herd believes the rate cuts are associated with a massive bull market. They are associated with bear markets. Again, 2021 was an outlier. You had the Fed doing QE 2.0. You had the government passing out a bunch of checks. That's only going to make the next recession all that much worse because they just didn't let it happen. They tried to paper over it. But over here, during this run, this is where we're getting all the QE. Again, the stock market is artificially inflated, more expensive than any other time in history. But this is what's going to happen. You're going to get the Fed dropping rates down to nothing, and you're going to get the stock market crashing. And this looks very similar to what we had over here, but they can't turn around and start passing out checks again because you know what will happen? You'll have a massive inflation problem if they do. They created a mess the last time around with the pandemic and doing that. Hope they've learned their lesson. The channel with the link directly below that allows me to be able to provide you this information. If you like the charts, you like the indicators, let me know that by supporting the channel today. Follow the link below to take you to a secured site and you can donate any amount you want. If you could take a moment to do that, I would really appreciate it. YouTube channels, most YouTube channels get sponsors, sell you stuff. I don't want to do that. They contact me all the time. I don't even respond to them anymore. If you have a YouTube channel, they constantly contact you. I don't want to sell you anything. So I just ask that you follow the link below. Do what you can to help out. Anything helps. Take a moment to do that. I would really appreciate it. I just put it all out there and ask that you do what you can to help out. So if you could take a moment to do that, I'd appreciate it. Thank you. The video all the way through, you're going to see my Elliot wave count from 1929 and on to the present. You're going to see the long-term channel that we're slamming up into. Right here we have. But this previously, last weekend, just real fast. Again, we're following this blueprint. The Fed cut before the election and then they paused for months. Now they've restarted in September 2007. They started in September. We got it on the 17th. Here it was on the 18th. The market rallied with the Fed cutting, and it topped 17 sessions later. In our current situation, we topped 16 sessions later. Then it began to fall back to the 50 period. We're at the 50 period right now, but that led to a nearly 11% drop, a rebound, and then a much bigger drop of over 20%, and that's when the Fed panicked. I think you'll see a bigger move, a bigger decline than what we saw back in February, which was 21%. I think you're going to see something bigger than that. I think you're going to go down to the April low, and if you do, you're talking about a 29% move or close to it if we don't quite reach it. We had the first cut in September. We just got the first cut in September, resuming the cuts. We peaked October 11th. We just got the peak October 9th. The cuts are going to be followed by more cuts. We had more cuts in 2007. In October and December, we got quarter point cuts. The Fed is going to cut. Those led to tops, by the way, and then more selling and more selling. We got a mortgage crisis going on. Now you got more concerns about the regional bank. You got a government shutdown. You got trade tensions. You got a lot of stuff going on. Easily give us a tumble of 20% or more. The regional banks will probably end up rattling the stock market more. The market shrugged it off on Friday. It's likely the beginning of something bigger. Down here where the Fed did an emergency meeting and they started jumbo cuts. They started with 50 basis points. In March, they did 0.75. Marked bottoms, but they were only counter trends, and I cut the chart off there, but I showed it to you last week. I'm telling you, we're repeating 2007 all over again, and the chart I'm going to be showing you, monthly time frame, is it 1929 all over again? Very, very similar bubble right now to what we had in 1929. I'm telling you, there's a very good chance the stock market is topping. We're eventually going to get the jumbo cuts out of the Fed, and that we're moving towards recession. The stock market peak right here, recession began by January, by December, and then the Fed, which is right in here, right in this area, and then right after that in January, the Fed panicked. But we're starting to get the cuts. You're going to get more cuts out of the Fed. Believes they're bullish, they're bearish, and it led to this. And again, I showed you, again, you ended up dropping, 57% or so after all is said and done here. This is the 2007 top. This is the S&P 500 with the first rate cut, and we've just had the first real rate cut here. Powell did a couple of cuts just before the election, and then he began to pause. We've paused now all these months. I want to encourage you, watch the video all the way through. I'll be talking about the big long-term picture. 1929 channel in the monthly time frame, the long-term Elliott wave count. Now, as the S&P comes right up into the parallel boundary to the lower trend line here, from the 2020 low, the 2020 low to the 2022 low to the 2023 low to the April bottom of 2025, hitting horizontal support from our 2022 peak. We've come right up into that and our 2023 trend line. We're hitting long-term resistance also in the monthly trend line from the April low. Again, this rising wedge, if we confirm the breakdown of the trend line here, from April, from May, as I talked about, and September, the shorter term trend, if we can confirm it, we need to close below 65.50 and a drop below our 50-period moving average, as I talked about. Now, this is, I think, is likely the case if we can confirm this bar as a reversal bar, get confirmation and a follow-through by closing below 65.50. We'll have a lower high and a lower low, as I've talked about. In my last video, I talked about how we have come back up to the moving averages, and we've now had, six sessions all last week, and the prior Friday's close, all 6 sessions have closed below the 20 period when we have held above the 20 period. The 20 period, so far, we've only been able to manage to close below it one time in each sell-off, just one day, and then you get right back above it. The 20 period has acted as support. Here we've closed below it, and you've been below it for 6 sessions. So again, if we're going to reverse, you've got to get a lower high, lower low, as I've said. Now this is what I think is likely the case. This is my Elliott wave count, Elliott wave speculation. Because we reached the 6,700 area in the trend line in the weekly time frame, I think this count is more likely. So again, we get a pullback, looks corrective, back towards the 100, the cloud, or maybe to the horizontal support, the 200, and it looks corrective. You still might get one more push higher in the fourth quarter here, later in the fourth quarter. I think it's more likely that if we can confirm this as a reversal bar and drop below the 50 period, I think it's more likely you get a corrective, not a corrective move, but an impulse move. You have the odds increasing that you've topped. So again, mark this as primary wave 1 and 2. This whole thing here is extended wave 3, 4, and then a 5-leg push higher into major resistance in the weekly time frame, forming our negative diversions. And quickly, if we can confirm the reversal bar next week and drop below the 50 period, then again, here's the alternative count. Now, this was my primary count previously. Again, because we've hit my target level, 6,700, and the upper boundary of the channel in the weekly time frame, I think it's more likely we're trying to top rather than a sell-off and then having this extend onward and on longer. I think it's more likely. I'm open-minded to this, and Elliott wave is speculation. Now, I told you down at the bottom, this was corrective. And therefore, we were going to go make new highs. Kramer was saying we were going to crash, and everybody was saying, it's over. So we were bottoming. And we got that hollow red candlestick at major support. It's all the major support levels on the weekly chart, horizontal support and the rising trend line. I think it's more likely that we're topping and you have a 5-wave impulsive move and we don't get this corrective move, but I'm open-minded to it. It would mean we have a massive extended wave 3, and I've marked that accordingly. So again, that would mean we get something like a 10% drop or so, something towards the 200 period or the 100 period, a little bit less towards the horizontal trend line, and then you get one more push higher. I'm open-minded to this scenario. If I see evidence of a corrective move, like a corrective move over here, corrective move here in primary wave 2, but if I start seeing evidence of an impulse move, and again taking out the 200 period, getting a bigger Fibonacci extension, then it's more likely we're headed back to the April low to give it all back. And again, I'm expecting a crash going into a recession. What usually happens is you get a top, the market starts crashing, the Fed starts cutting. 2007 and 2000, they didn't start cutting. They waited and waited and waited, and then they panicked all of a sudden, and you got a bigger cut. I think it was 3/4 was the jumbo cut with 2001 in January of 2001 because they waited, leaving their own nonsense about a soft landing. Now, Powell just spoke, and he's starting to show concerns about the economy. He's going out the door. He's gone in May. He's going to start slashing rates. He doesn't want massive inflation on his way out the door for his legacy, and he doesn't want a recession for his legacy. It's too bad he's going to get stuck with one because we're going to have a recession, and he's responsible for it partly. He kept rates too high for too long, just like back, when they did the rate cuts during the pandemic. They kept rates too low for too long, did all the stimulus, and they gave us all this inflation. They caused it. So supply chain disruptions and all these, they caused it. And then they enabled the government to pass out a bunch of checks, 5-6 trillion in checks, government deficit spending, and that's what causes inflation, along with their QE program. They did QE 2.0. That's inflationary. But they want to get credit for saving us from the pandemic and all this other stuff. Fed's policies lead to negative outcomes. I think you're going to see Powell starting to cut rates here, and then I think by December or January, Powell's going to panic, the Fed's going to panic. We'll likely start seeing real evidence that things are wrong with the economy, and we're already starting to see that now with the regional banks. Again, I've been warning about for a very long time, the commercial real estate crisis is going to spill over into the banking crisis. They have huge exposure. The banks have huge exposure to commercial real estate. Concerns about the loans, the banks' loans going sour, going to happen, and it's going to give us stress in the credit markets. Eventually, you'll get your black swan event with that. Talking about this coming down the pike, and will be associated with the recession. It will be associated with the bear market. This is this long-term monthly channel, and I've talked about this before, but we've overthrown the upper boundary of the channel. And so what I want to show you is, this goes back nearly 100 years to the 1929 top, in the Great Depression and all that. And again, I think we're going to be moving into the Great Depression. I think we're going to have something that's going to make that look like nothing. Not with this financial crisis that's coming, but with the next one in the early 2030s. There's going to be a recession. We'll have a bear market, and then we'll have a new bull market, and then you're going to have another bear market that's going to really be really bad. That's about the time the debt bomb is going to explode in the early 2030s. Probably have a bear market into 2026 and 2027, new bull market, and then at some point in the early 2030s, you're going to have, 2030, 31, 32, 33, 34, somewhere in there, you're going to have the Great Depression hitting because of all the crazy spending from the politicians, giving us, what do we have, 38 trillion in debt now? Eventually, the debt bomb will explode. It's going to happen. Any economist worth their salt knows it. Most of them, like the economists over at the Fed and of them, are in denial about it. It's like our recent inflation that we don't have inflation anymore. We haven't seen inflation like the, big inflation like that since the 1970s. And they get complacent. Oh, it hasn't happened yet, so it's not going to happen. But I'm telling you, the politicians, spending like drunken sailors, are bankrupting the economy, or the country, I should say. And again, we are going to have a Great Depression, and it's going to hit in the early 2030s. The Fed over there, they're a bunch of Keynesians. They don't believe these kinds of things. They had a housing bubble. They told us there is no housing bubble. Before the recessions hit 2001 and late 2007, a soft landing, or like with the inflation rising to 9%, it's transitory. These are the kinds of things that you say when you're oblivious to what's going on, when you believe Keynesian economics. The Fed's a bunch of Keynesians over there, and that's why they never see anything that's coming. It was just back in December, Powell told us, it's clear we've avoided a recession. Exact quote. It's clear we've avoided a recession. Think they can micromanage the economy, and they can't. Policies always lead to negative outcomes. Always. See, the crash over here, the crash that caused in 1929, that caused the Great Depression. No, it did not. You know who caused the Great Depression? The Fed. Using rates to nosebleed levels when there was no inflation. And we had, but wait a minute, we had tariffs back then in the 1920s, and then more in the early 30s there. We had tariffs. Of course there was inflation. Just like right now, the media tried to convince us that the tariffs were going to cause, hyperinflation. Us down at the bottom in April that the economy, we're going into the next Great Depression right now. And we're going to have a recession, but later you're going to have the Great Depression. We're not going to have that with this downturn. But again, you know what caused us? The Fed. Sometime before you die. Read Milton Friedman's work on this. He wrote an entire paper about how the Fed caused the Great Depression. Later wrote about it in his book, A Monetary History of the United States. Now, you want to read something worth reading and something that makes sense, you read Milton Friedman's book on the Great Depression. You understand the Fed caused it, how they failed to act. Then the Depression dragged out even further. President Roosevelt, FDR, came in and he adopted Keynesian economic policies and dragged out the Depression even longer. And it lasted another 6 or 7 years, longer than it should have, because of Keynesian economics. Yeah, just as the Fed caused this, the Fed and their policies, QE, blowing the bubble so big, the Fed is going to cause our current downtrend, our current downturn, and the next one that we're going to get at some point in the 2030s. You're going to have two, and that's what the high valuations are telling us. Like the Buffett indicator, record levels, and the Shiller PE ratio, and all these things are telling us that you're going to have a crash or two over the next 10 years, and returns are going to be negative or very, very low, because you're going to have a couple bear markets and a couple crashes in the next decade, like what we had over here in 2000 and 2007. Again, you went nowhere for 13 years. Over here, you went nowhere for about 16 and a half years in the 60s and 70s. And then over here, again, you didn't go back and make new highs until 25 years later or so. By the time the market recovered, you were dead in all likelihood. The market has these long periods of drawdowns, as you can clearly see here on the monthly chart. Now, nevertheless, I digress. We have two channels going on here. This is going back all the way into the early 1930s. In the trend line here, I've included lower boundary. That's the red channel. We overthrew that. You hit it here in 2000, connecting 1929 to 2000. You hit it again there in 2022. But then we overthrew it 2024. We got that peak in 2025. And I've marked 2024, 2025. This is what's going on here. And in 2025, February, we sold off. We came back up, and we've made new highs now. That's our October 9th on the S&P 500, our October 9th from a week and a half ago. Now, and we exclude the shadow down here, the black line right here, from the lows here in the early 1930s, then it's a little bit higher. And 1929, you come up here, and you didn't quite reach it in 2000. You didn't quite reach it in 2022. You didn't quite reach it February high, but then you've now come up to it with our October 2025 high, and you're coming right into that channel line. So again, we did overthrow it with the red channel. The black channel, we're slamming right into it right here, right now, excluding the shadow low from this low right here in our monthly time frame. Are you picking up what I'm throwing down? So again, we're still reaching the upper channel line. So you're hitting this upper channel line, excluding the shadow, which makes the angle of ascent slightly slightly higher than the red channel that we're overthrowing. We're slamming into the channel and this is our log scaling. I'm showing you with the 2020 low is the linear scaling. Getting some major resistance here. Now, this monthly chart up close here so you can see. Again, I've taken the bottom here. I've excluded the shadow. The red channel includes it. Here, I've excluded the shadow from, I guess it would be the early 1940s. I think I said from the early 30s and early 1940s. That trend line right there. You're slamming up into it right here, right now. Now, you know how on my charts you see these longer term counts and you're going, where does this all fit in? You're going to see it right now in the long term chart. Here, again, I told you down over here, I believe we finished intermediate wave, cycle wave 4. This whole thing, I believe, is likely now completed cycle wave 5. Alternative scenario would be we sell off, we go back up, and then we complete cycle wave 5. And that's this Roman numeral 4 right here. These counts with the circle, those are primary waves. Between them are minor waves, making up the primary wave. Now the counts right here, you're going to see cycle wave 5. We finished primary wave 5 here. These 5-wave push higher. We completed cycle wave 5. If it's done, then you've completed the super cycle and the grand super cycle on top of that, which you're going to see those counts right now in the monthly time frame. And that's these counts right here if we've completed the cycle wave 5, completing primary wave 5 primary waves higher. So if we exclude, if we exclude the shadow there, as I showed you up close, then you're slamming right into the trend line right now, in the area we are currently just turning off of. Now, zooming out here, we can see the bigger count. Marked here in black, I have the super cycle. I think from the low in 2009, this entire bull run, very similar to the bull run that we've had up here. I think you have something very similar to that, and similar to something like right here after we went sideways in the 60s and 70s. Following each major corrective move in the 1930s into the early 40s there, and then in the 1960s and 70s, and then again we went sideways 2000 to 2013, and then again the run up there. So each time, major drawdown, you've had these moves higher. The 2009 low, I think we've had a 5-leg push higher. I think the Wave 3 of the super cycle completed in 2022. The 2022 low, I think, was super cycle 4. And I think this whole push up from the 2022 low is the 5-leg push higher for super cycle wave 5 coming into this trend line right here. And then I think that's completing the grand super cycle, which, again, I think that the wave 1, the rally going in, the big run up in the 1920s and 1929 top, I think that was wave 1. I think we have wave 2 here. I think we have an extended wave 3 for our grand super cycle into the 2000 top. I think you have an ABC here to the 2009 low. I think that was your wave 4 of the grand super cycle. And I think, again, the super cycles 5-leg push higher is completing super cycle wave 5. So I think that we're coming to a conclusion with this long-term 5-leg push higher up into this upper channel line parallel to the lower boundary here. If we exclude the shadow, you're slamming right into it, just overthrowing it. If we include the shadow, showed you with the red channel previously. I think you're going to get a bear market that's going to come down and either take out the pandemic low, which you could see right there in 2022 or in 2020. I think you're either going to get a higher low just above that or just below it. Now, we could go to this midpoint right here, and if you do, then you're going to be just slightly above that level. I think you're going to get a bear market going into 2026. Maybe it drags out into the first part of 2027, but I think you're going to get a bear market, and then I think you're going to get another bull market. Now, I think we've got an ABC right here for, again, the super cycle that will eventually give us the next two bear markets off of this trend line. I think you're going to get one here, but then I think in late 2026 or on into the first half of 2027 somewhere, you're going to find a bottom. Before the general election in 2028 happens, you're going to be recovering from a bear market. This is going to take us somewhere into the early 2030s, 2030, 2031, 32, 33. And again, the politician, the government, they can do accounting tricks to make it last longer. So, it looks like it might hit around 2030. 2029, 2030, 2031, they can do accounting tricks that can make it last longer. I'm just saying somewhere in the early 2030s, 2030 to 2034, 2035, somewhere in that area, you're going to see the Great Depression hit. It's going to be the politicians that have given it to us with their crazy spending. They're spending, making $5 trillion and they spend $7. During the pandemic, they raised spending levels by 40%, and they've never brought them back down. They just keep it up because the government doesn't know how to live within its means. That's why we're eventually going to have the debt bomb explode. It's unsustainable. You cannot continue to run a deficit every year of $2 trillion. George W. Bush, he was doing hundreds of billions in deficit spending. I think his worst year was around $400 or $500 billion. Then Barack Obama came in, and he was doing $1 trillion in deficit spending, the Obama administration, every single year. The Trump administration came in, the deficit spending continued. And then in the last year of the Trump administration, again, the pandemic elevated the spending by 40%, bailout, and then the Biden administration came in, they doubled down on that, and they did another round of stimulus. And over the 4 years of the Biden administration, we increased from deficit spending of $1 trillion to $2 trillion a year. This is unsustainable. At the moment in the Trump administration, we're still seeing the crazy spending. Despite DOGE and some of the downsizing of the government, we're still seeing unsustainable levels of spending. It's going to happen. No political will to stop it from happening. So I think you're going to get these next two bear markets, and that's what the valuations are telling us. You're going to have a couple of bear markets like you did over here, like you did in the 60s and 70s, like you did back over here in the 1930s and early 1940s. I think you're going to get a downturn towards the pandemic low or just beyond it. I think you'll get another bull market, and then I think you'll eventually come down to this trend line right here. I think you're going to come back down to this level right here, the 1550 to 1575. These two highs were within 25 points of each other, 1550, and then we went a little bit higher, and we went to 1575. This is where I think the next one's going. But I think you're going to see move back to this midpoint here, back to test the pandemic low, either just above it here at this trend line or just below that level. Now, if we get a 50% sell-off with this bear market that's coming, you're going to take out the 2022 low. Okay, you're going to take that out. You'll drop 3,382 points, and you'll drop down to the 3394 area, and this low, right near this low at the 3,400 area. Now, if we get something bigger, because the S&P is now NASDAQ Junior with about 7 companies influencing it, behaves more like a tech stock and has heavy tech influence, then I think you could get something more like a 60 or 65% drop with the S&P 500 that could take us closer to this level, maybe even something bigger. But if you're getting, say, a 65% drop, then you're dropping 4,400 points, and you're going down to the 2370 area. Down here we had the 2200 area here at the pandemic low. So again, this is where I think, and again, could be something bigger, but I think you're moving down towards the pandemic low. Bitcoin's topping right now. I think it will drop 80 to 90%. NASDAQ, when it dropped back during the bursting of the tech bubble over here, it dropped to 82%. If you got the NASDAQ dropping 70 or 80%, and the bursting of the tech bubble happened back in 2000, NASDAQ quickly dropped in 2 months. It dropped 42%. nearly a 50% haircut very quickly. And you're going to see something like that happen too. When Bitcoin peaked in 2021, it dropped 52% in about 2 months. So you're going to see something happen. This is what's going to cause the Fed to panic. And I think that's coming in December, January, coming months ahead. If we have peaked and we start to see the drop, rather than just a pullback, in the coming months ahead, the Fed will panic. If we drop, 60% or so, then you're moving back to this trend line right here. So again, I think, you're going to see a greater move. This drop right here is 50%, 51%, I believe. This one was 57. I think you're going to see something around 60 or 65 that's going to take us back to this midpoint here in the long-term channel. And I think you'll see that happen going into late 2026 on into 2027, and then you'll start a new bull market. That'll be the wave B, and then I think you'll get wave C. Now, this could unfold in a 5-3-5 pattern, or what I have marked here could possibly be a flat. A zigzag would be a 5-3-5. Here, it could be also a 3-3-5, or it could be, if we go to new highs, if we get an expanded flat, you can come back up here and you can hit it again, and you can top, and you can get a 3-leg push down, a larger ABC, would likely unfold in a 5-3-5. If you're going to get something dramatic, it'd probably be a zigzag. A 3-leg push down for A, you get a 3-leg push back up for B, and if it's expanded flat, you come back up and you take out this high, and you go back down and take out that low. So an expanded flat, or a regular flat, or a zigzag, it can unfold in any of those corrected patterns for the ABC. Just showing you the big roadmap going forward. I think you're going to have a bear market. I think it'll be followed by a bull market going into the early 2030s somewhere, and then I think you're going to have another bear market. I think you're eventually coming back to the trend line and coming back to horizontal support here at 1550 to 1575 or so. I have this going into the late 2030s. On that, once we reach this trend line, I haven't thought that far ahead, but this is what I think is happening long term. So I hope this count helps you. It helps me look at the bigger picture of what I think is going on. It's really in agreement with the valuation. So we have the most expensive stock market in history, and valuations tell us we're going to get couple of drawdowns over the next 10 years here, maybe longer. Again, 13 years here, 16 and a half years or so here, 25 years here. This is telling us at least 10 years, you're going to have a couple of big drawdowns. So you're going to have a bear market, a bull market, and then another bear market. This one over here, it happens in the early 2030s. I think that'll be the Great Depression. And there's not one thing that's going to stop it from happening. They can delay it, but they can't stop it. Politicians and their reckless spending, the Fed blowing the bubble so big with their QE nonsense that we've had all the rounds of QE ever since here, blowing the bubble, artificially inflating the stock market. Their policies will ultimately lead to a negative outcome, which is going to be this.